Hey everyone, and welcome back to the 18-part series on the dividend ETFs with more than $1 billion in assets. We're going to be looking at all 18 of these ETFs over the next few weeks. Earlier this week, I posted a video on SCHD, and in that video, I asked you to leave a comment in the comment section which of these ETFs you wanted to see next. And overwhelmingly, everyone wanted to see SCHD. I'm going to go ahead and talk about that one today. If you want to vote on which ETF we cover next time, go ahead and leave a comment in the comment section letting me know which one you prefer. So thanks to everyone who left a comment last video. I also had a couple other comments I wanted to address in this video. First of all, shout out to Jay. He asked if I could start showing the history of dividend payments. So are they stable? Are they increasing? If you're looking for income from your portfolio, particularly income that's growing, that could be a useful ad. So I'm going to actually start doing that this week. Mike also mentioned that at some point in the future, maybe I could do a wrap-up video with different tiers, giving you guys a little bit more of a bigger picture view on how these ETFs stack up. So I'm going to go ahead and do that at the end of this series. And then Oleg mentioned that I should have factored in total return into last week's video, and I actually did. I did include dividend reinvestment, and all of the videos that I show, all the data that I show always assumes total return, including dividends reinvested. I typically fail to mention that in every video, so just be aware that that's the case. I'll try to remember to say that in future videos. Without further ado, on to today's video. We're looking at the Schwab US Dividend Equity ETF. So in this video, we're going to look at some quick facts. So what is SCHD's dividend yield, its fees. We'll also then look at the dividend history, which is a new addition to the series. We'll look at how that has grown over time. We'll also look at how SCHD selects its stocks. Then we'll take a look at risk. So how does SCHD perform in bad markets? Take a look at the holdings, including both stocks, individual stocks, and sectors. And then at the end of the video, we'll talk about how the ETF has performed over the last 5 years. And then we'll also look at the index that SCHD tracks, and I'll show you how that index has performed going all the way back to 1990. So this ETF tracks the Dow Jones US Dividend 100 Index. I'll tell you how that's constructed here in a few minutes. $12.69 billion in assets. The dividend yield over the last 12 months is 3.2%. I will note that all of these dividend yields do not include any recent dividend cuts. So just keep that in mind. If there are underlying stocks here that have cut the dividend, that may be a little bit overstated. And then the expense ratio at a pretty low 6 basis points. Here's the dividend history that Jay suggested I include. So here we see that in general, SCHD's trend has been positive. Looks like the compound annual growth rate here from June of 2013 at 23 cents per quarter to today's dividend at 44 cents per quarter. That's a compound annual growth rate of about 9.8% per year. You had this 24-cent dividend cut from this ETF. This would have been 9 of 2016. This, I think, was probably due to the energy crisis. I would assume this ETF owned a decent amount of energy through here. Those were pretty high yield names. That market collapsed here in 16, so I'm assuming that's the cause. It did rebound fairly substantially and then continued to even out. So that is one thing to note. As the last couple of years, the dividend distribution has declined a bit. So that could happen for a couple of reasons. One, you could have a lot of the higher yielding names in this index no longer meet the profitability criteria that the fund requires. So those could be kicked out and replaced with lower yielding names. You could also have dividend cuts from some of the names that were in here. That's another factor. Or you could have, in some cases, a big special dividend. Maybe there's a tax change and companies pay huge special dividends in one particular year. That could give you, a huge spike like this, or maybe like this. So there's a lot of factors that go into this, but broadly speaking, I think this is a pretty positive picture. Now on to the strategy. The starting universe here is the Dow Jones US Broad Market Index, which is basically every stock and ADR in the United States. This also excludes REITs, which is now the third ETF out of 4 to exclude REITs, pretty common. It has to have at least 10 years of consecutive dividend payments. This is the same as VIG, which we will see in a future video. The minimum market cap has to be 500 million, so we're not dealing in super small companies here. Then we also have to have a minimum 3-month average volume of $2 million per day. So there are pretty liquid securities. And then the stocks are ranked in descending order by IAD yield, which is essentially dividend yield. And then the top half of those are selected and proceed on to the next criteria. Say you've got 2,500 stocks that make it through these kind of broad requirements. The top half of those would basically leave you with 1,250. Basically, you're going to end up with a decent amount of stocks passing this initial starting universe. That then takes us to the next step. This index actually applies a fundamental scoring method. So we've got a cash flow to total debt. 2, return on equity. 3rd is that dividend yield, and you'll note it's indicated dividend yield, which actually means the company announced, say they announced a dividend increase or a dividend cut in the most recent quarter. This will annualize that to include what the future dividend will be, not necessarily what the past has been. And then also it incorporates the 5-year dividend growth rate. And then it's going to rank all of those into a composite. Let's say there's 1,250 stocks that make it through this. Each one of these is going to be ranked from top to bottom. So the company that has the most cash flow to debt is going to get a rank of 1. So basically any company with no debt gets a number 1 ranking. Return on equity, let's say that's number 100. Let's say dividend yield is 500. And the 5-year growth rate is 250. Basically, we're going to add up all of those. So in this case, sounds like it would be 851. So the total score for this hypothetical stock would be number 851. And then that is going to be compared to all the other stocks that made it through the universe. And then the lowest 100 are going to be selected. So once they have those lowest scoring 100 based upon those metrics, the constituents are then going to remain in the index so long as they score in at least the top 200. So for example, let's say Apple is in the index. It's the number 100 ranked stock. It barely made it in the index the first time. Once it's in, it's not going to get sold. Let's say it drops, next rebalance schedule is now ranked number 105. Apple's not going to be sold just because it doesn't meet the top 100. It has to fall then below 200 in order to be sold. So this just reduces the total turnover for the index. Then those stocks are weighted according to market cap. There is no stock that's able to receive more than a 4% weighting. So Apple, for example, in a portfolio of any 100 stocks, Apple is going to be a huge percentage of the total market cap of that portfolio. So to prevent that from being, a 20% weighting, they do cap them at 4%, and then they'll recalculate the market cap calculation based upon that adjustment. The sectors are limited to no more than 25%, and of course no REITs are there. The index is rebalanced annually unless there's a weighting cap trip. So this weighting cap is basically preventing this index from looking like the NASDAQ, for example, where you've got 5 or 6 stocks just absolutely dominating the vast majority of the market cap weighting. If you do get a huge run up in some of these stocks, and the total amount of stocks that are currently weighted at 4.7% or more, if that exceeds 22% of the overall portfolio, that triggers an automatic rebalance. Now let's look at the risk of the portfolio. The benchmark we're looking at as a comparison is the Russell 1000 Value Index. So if we look at the upside-downside capture ratio, we see that this fund is favorable compared to some of the other ETFs we've seen, but still not a great upside-downside capture ratio. So in general, when the market goes up 10%, this fund goes up an average of 9.4. When it goes down 10%, it generally captures more of the downside at 10.6. What really matters though is how much the maximum drawdown is. That gives you a lot of indication of the quality of an underlying index. So last video we saw that SCHD had a maximum drawdown of a little bit over 30%. Here with this one we see a minus 21.5%, and that was from January 1st to March 31st of this year during the COVID crisis. So it did a good job, particularly compared to the value index and the value mutual funds. There are a couple things to note on the sector weightings. One, the financial services is about 5% overweighted relative to the value index. There's also quite a bit of industrial exposure here, at almost double what there is in the value index. Technology is very similar, but it is quite a bit less than what you would find in the S&P 500. QQQ is about 50% technology, so quite a bit underweighted compared to those two indices. It is very overweighted in consumer staple stocks, which is part of the reason why it had less of a drawdown. It's quite a bit underweighted in the healthcare sector, more than 11% underweighted. And then it has no exposure to utilities and no exposure to real estate. Here are the current holdings as of September 3rd. You can see a few of these stocks are now exceeding that 4.7% weighting, but we only have 2 of them at the moment, so I don't think it's anywhere close to tripping that automatic rebalance feature. But you do have a pretty good balance here of quality names. Obviously UPS, Texas Instruments is a high quality name, BlackRock, Pepsi, Coke, Verizon, Altria's having problems, but it's a nice yield, good competitive advantage there. Pfizer, 3M, IBM's had struggles, but for the most part, a very high quality look to this group of stocks. Not an overwhelming amount of leverage in a lot of these names, unlike what we saw with last week's SCHD. The performance of this ETF has been pretty strong, particularly relative to the value names. So this is compared to the Russell 1000 Value Index. You can see that over the last 5 years, this fund has outperformed that Russell Value Index by over 5.5% per year, which is very impressive. The last 3 years, it's outperformed by 6.8% per year. Then it's had a very good last 1 year, outperforming the value index by 10.4. It's still not holding up with the S&P 500 year to date, but that's a pretty tall order considering how well some of the large cap growth stocks have done and really pulled up the S&P. So this is actually really impressive on all accounts for this ETF. The index performance has actually been even more impressive than that. So the SCHD tracks this index, the Dow Jones Dividend 100 Index. So if you type in this ticker symbol in the Bloomberg terminal, you can pull up how this index would have hypothetically performed going back in time. So this goes to 1998. You'll have to forgive me, I think I said 1990 in the intro. 1998 is when this index was, we have data going back that far. Going to yesterday, last trading day, this index produced 10.44% per year, and that compares with 7.08% for the S&P 500. It is worth noting, however, that this fund outperformed quite a bit in the 2000 to 2003 tech bubble collapse. So if you eliminate that period, a decent amount of this outperformance evaporates. But nevertheless, this is very clearly impressive performance from this index and the ETF itself. So overall, I think a massive pro, like we just talked about, was that impressive performance. This also has a really nice blend of high dividend yield, not being too high, and still retaining a lot of the high quality that you really want to look for in an ETF and individual stock. It also has performed the top 2% in the large cap value category, so one of the best performing funds in that space. I also really like the number of holdings here. It's not so much to where you end up basically replicating the index, but it's also not so little that you have a very, performance. The performance is not that volatile. You've got a nice solid basket of 100, which is different enough from the index, but it's also concentrated enough to really give it a potential to outperform. And the razor thin 0.06 expense ratio is also quite favorable. Only two cons that I could come up with: the performance in the bull markets has not been as strong. So if you look back to the inception of this ETF in 2011 to yesterday's trading day, the SCHD had underperformed the S&P by about 2%. Most of that would have occurred within the last couple of years. So in a bull market, this is probably not going to keep up, but that's probably not why you're buying this in the first place. Just something to keep in mind. And then the value tilt does make this a bit riskier than other more quality focused ETFs. So for example, VIG is one we'll look at. That one has much more of a quality focus and will hold up a little bit better than this one will in a down market. Overall, I think this is a very impressive ETF. So leave a comment in the comment section if you want to vote on which ETF we cover next. If you have any suggestions for how I can improve these videos or make them more helpful for you, leave a comment in the comment section as well.